Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. I've been speaking a lot about the U.S. of late, and we did get the minutes from the Fed this past week, but the information mostly served to reinforce our views on the taper timing, which is for some indication that it's imminent in September, an announcement in November, and start of taper in December. So with that said, I'm actually going to shift gears this week and focus on the UK, as we got some important data there this week in employment and inflation. Now, this podcast is being recorded before we get the retail sales data, so we'll see how that comes in. But the employment data continued to show decent progress towards reduction of slack on the labor side. However, inflation was softer than expected, and that is in line with our view that inflation in the UK is going to be more transitory, whereas in the US it's going to be less so. And as listeners will remember, we took a look last week about the US and how the US dollar angle from the Fed and their reduction accommodation and their taper plans, how that would impact the dollar. But this week, I want to take a look at the other side of the coin, which is why I have Paul Robson, our other co-head of G10 FX Strategy, with me today. So Paul, last week, Brian reviewed our overall defensive approach to the dollar and how we continue to shy away from broad dollar shorts and have done so since early in the summer. But from your perspective in London, from a sterling perspective, we've moved lower from 140 to now below 137 just in these few weeks in August. So what are your thoughts behind that move? And has this recent data we've gotten this week impacted our outlook for sterling?
Well, I think when you look at cable, so sterling dollar, I think it's just been another week, another story of the dollar, things that Brian would have spoken about last week. More sort of risk aversion in markets, the sort of dollar does better, safe haven status when markets are a little bit more fearful, sort of less about US exceptionalism. In fact, some of the data out of the States has been a little bit weaker, and actually that's caused some of the risk aversion, ironically, that has seen people buy back some of their dollar shorts that they might have had against sort of risk positive currencies. And you've also seen the sort of other safe haven currencies doing relatively well. So a large part of that decline that you spoke about is more about the dollar side of it than sterling. That said, for sterling, it's a sort of high beta risk positive currency. It's a current account deficit currency. There's sort of uncertainty, obviously, about COVID, still lingering uncertainty about Brexit. So, I describe it as a sort of fair weather currency. To do well, it needs risk markets to do relatively well. And that's why I think you're seeing sterling come off a little bit, but importantly, only against the safe haven currencies. It does better on the sort of bilateral rates against things like Aussie, for example, and Kiwi. In terms of the data, you mentioned the CPI numbers. Yeah, they were weaker than expected. I mean, I would take them with a little pinch of salt. There's lots of uncertainty about these data, sort of seasonality in the data, the timing of sales. I think it's quite hard to properly estimate inflation. And of course, we had some quite decent employment numbers as well. And I think the key takeaway there is an economy that is normalizing more quickly than policymakers had expected. People are revising up their growth forecasts. And importantly, the sort of economic scarring from COVID is probably less than markets feared, that say just sort of 6 months ago. So I think that a large part of it isn't a sort of deteriorating sterling story, but more broader risk appetite and the dollar.
So you're leading me a little bit into my next question, but I'll add that, also we've got the better COVID related data in the UK. So if we get past this risk aversion, maybe you'll see that also kick in when it comes to, the Delta and the variants and such. But where's the euro in all this? So in the back of my mind, and this is where something you said struck me, is the fact the Bank of England, if you've got an economy more normalizing more quickly, maybe the earliest hiker of the major central banks, followed by the Fed, and then perhaps eventually the ECB. I mean, how does that all focus into your thinking when you're thinking about the currency market?
Well, I think for the euro, it's not necessarily that the euro is going to track rate expectations, and obviously the ECB is fundamental to that. But it's about the things I've spoken about in terms of safe haven currencies, the currencies that might be preferred as a funder for risk positive trade recommendations or trading views if and when markets start to do a little bit better. So if you expect the ECB not to be raising rates, well, potentially into 2024, 2025, then it's going to be favoured as a funder currency. And so what this means is that when risk markets rally, the euro will tend to underperform a little bit against the dollar, depending on relative growth, but against high beta currencies. But it also means that when you get risk aversion like we're currently seeing, then the euro does relatively well. And actually that's actually picked up in recent days, where you're seeing the European crosses all rally. Now, at the same time, I think we have to be mindful of the level of growth within the euro area. So our European economics team are above consensus in terms of growth. And at some level, that will see unhedged capital inflows, portfolio flows into the euro area, potentially supporting the euro. Now, for that, I think you're just going to have to see some softer trends in US data, or at least that it's fully priced. And there, I think the US consumer will be what people are watching. But until US exceptionalism starts to fade a little bit, even that strong growth in Europe might not be enough to send euro dollar higher. So when we look to the future, it feels like euro dollar capped to the ranges, a slight bias lower, and a rally will probably need some signs of inflation picking up earlier than expected, harder than expected in Europe, but probably softer data in the US. And at the moment, that doesn't seem particularly likely. So we're just neutral on euro dollar at the moment.
Thanks, Paul. It's really helpful, though, what you're talking about as far as like long-term frameworks to how to think about, some of these currencies as far as safe havens or high beta to risk, and, how much that's being all caught up in this current, risk off growth worry phenomenon, that if we're able to get past that, some of these themes or trends from maybe a couple of months ago can reengage. That's very, very helpful. Thanks for joining us this week, Paul. So that's going to be it for this week. Next week, we get preliminary PMI data. So we'll see if that shakes up any of these currency pairs, as well as European sentiment data and the Fed's Jackson Hole conference on Friday. Thank you and have a good week. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.